Flight to safety equals lower rates. Hey, it's Eric Osnes here with Homebridge Financial Home Mortgage with my weekly update on mortgage rates for the week ending March 17th, 2023. I'm so glad this week is over. It caused me some latent PTSD from a decade ago to watch several banks fail, and along with the ensuing federal bailouts that happened after that. What did happen? It really boiled down to an old-fashioned bank run, starting with Silicon Valley Bank, followed by a couple others. After a tweet from a venture capital firm, depositors at Silicon Valley got nervous and started pulling funds from the bank. But the bank did not have sufficient liquidity to honor those deposits, leading to its failure. The bank made, according to experts, a rookie mistake by investing too much in long-term investments whose values plummeted with the rising rates. Our banking system is structured on what's called the fractional reserve system. Banks are only required to hold a small fraction of the deposits they take in, roughly 10%, let's say. The rest is lent out. If more than 10% of a bank's depositors try to withdraw their funds, the bank doesn't have enough money to give them. They have to sell other assets to meet that demand. But if the value of those other assets has dropped, like long-term treasury securities have, well, then Houston, we got a problem. There's going to be lots of finger pointing about who's responsible for this fiasco. I'm a bit more concerned about the question of where do we go from here. 93% of the deposits at Silicon Valley Bank were uninsured by the FDIC, but depositors are bailed out anyway. What message does that send to depositors, and probably more importantly, to other banks for that matter? Does that endorse additional irresponsible behavior? I teach continuing education, and I actually have taught a history class on mortgage finance. And our banking industry has an over 200-year history of this. Bad behavior leads to a crisis. Then new laws are implemented to eliminate that bad behavior, later to be rolled back as the economy improves, leading to a new round of bad behavior and a new crisis. And here and on we go. The cycle continues. Fortunately, I guess for mortgage rates, this fiasco led to a flight to safety of investing. We call it flight to safety. And that was actually good news for mortgage rates. So let's look at the national averages here. Conventional 30-year fixed rate, 6.55%. That's down almost 1/4% from a week ago. 15-year fixed rates, 5.98, finally under that 6% mark. 30-year fixed rate FHA and VA, 6.15 to 6.19. Those are also down nicely from a week ago. 30-year fixed rate jumbo, 6.12, also down almost 1/4% from a week ago. 5/1 ARMs, I don't talk about too much just because we have lots of different adjustable rate programs and there's different versions available, but we have what's called an inverted yield curve. And what that means is that shorter term securities are actually paying a higher rate than longer term securities. It's upside down. As a consequence, shorter term loans, like adjustable rates, where we fix the rate for 5 years, 7 years, 10 years, in many cases have a higher interest rate than a 30-year fixed rate loan. It's upside down. So those programs are not the most attractive at this time. All right, moving on. What's a LLPA? For a long time, bureaucrats have been complaining that we need more affordable housing. I don't disagree with that. But other bureaucrats are busy making home financing more expensive. It would be really nice if they would just work together, but they're not. Recently, the Federal Housing Finance Agency, FHFA, they have oversight over Fannie Mae and Freddie Mac, made significant changes to LLPAs on conventional mortgages. That stands for loan level pricing adjustments. These are adjustments made to the cost of a mortgage, your interest rate, based on multiple factors. The amount of your down payment, the type of property, if it's a single family home, condo, manufactured home, multifamily home, the occupancy, if it's owner occupied or a second home or an investment property, your credit score, your first time buyer status, and even your income level if you're above or below the median income levels for the area in which you're borrowing. Many borrowers will benefit from these upcoming changes, especially if you're a first-time buyer or if your income is below those median levels. But man, if you're not a first-time buyer, or if you have higher income levels, it's going to get more expensive. The FHA was even going to add an additional fee if your debt to income ratio exceeded 40%. In our area, that happens a lot just because home prices are high. Uh, so fortunately for us, though, that debt to income ratio requirement has been postponed or delayed thanks to some pretty aggressive lobbying efforts by advocates for affordable housing. These new rules go into effect May 1st, so you still have a little bit of time to sneak in under the old rules. So to find out how that's going to impact you, just reach out and I'd be happy to run the numbers. You can call me 206-915-3742. That's 206-915-ERIC. You can email me, eric@ericismybanker.com, or look for me on social media. Just search Eric is my banker and you'll see me all over the place. That's all I've got for this week. I hope you have a wonderful weekend. Happy St. Patrick's Day to all of you, and I'll talk to you next week.